Everything you need to know about using leverage to invest. In this video, I have one key message, which is that leverage doesn't have to be risky. You can mitigate the risks if you know what they are and if you know what you're doing, and that's what I intend to teach in this video. Most importantly, you can actually use it to decrease risk while increasing return. How do you do that? Well, let's imagine you have a portfolio of 100% equities. You'll get an annualized rate of return of, let's say, 8% and a risk as measured by standard deviation of 17%. Okay, imagine that's your portfolio. Imagine a portfolio of 100% bonds, which obviously has less of a return, but also has less risk. If you diversify your portfolio of equities to a portfolio where you have 30% equities and 70% bonds, that's a very good thing to do. Diversification is very good because it reduces risk. But in this case, it also reduces return because bonds have less return than equities. But you'll see that your return goes down to 6.6% from 8%, but your risk actually goes down to below the risk of a portfolio of 100% bonds, because when you add in equities to bonds, right, these are decorrelated. So it actually decreases the risk of a portfolio of 100% bonds because they move differently to each other. That's one of the benefits of diversification. The thing is that diversification usually decreases returns. That is what leverage is for. Ta-da! You can target an 8% return, okay, and if you use the right amount of leverage to get an 8% return, which I calculated was an extra 21%, and you use that on the same ratio as this portfolio, your risk of that portfolio is 9.7%. Even though you have the same return as this portfolio of 100% equities, right, you have much less risk. And if you use even more leverage to target the same amount of risk, instead of targeting the same amount of return, you're leveraging that portfolio so you take on as much risk as a portfolio of 100% equities. With this diversified portfolio, you get an annualized return of 14%, which is much more, and it's much better. Okay, this is the right way to use leverage. It can be very risky if you use it to blindly chase returns because you're increasing risk at the same time. So imagine if you use leverage on a portfolio of 100% equities. That's so much more risky, and it's needlessly more risky. You don't have to do that. If you did that, trying just to get a 14% return, you'd take on way more risk. It's just stupid. Don't do that. Sometimes you can make it work depending on your investment goals and depending on exactly how you're using the leverage. But most of the time, if you're using it to just blindly chase returns without taking into account risk, it's just stupid. Leverage should be used firstly to attain a better risk-return ratio with diversification, and to use leverage so that diversification doesn't decrease returns. And then you can scale that ratio into the exact amount of risks and return that suit your target. Maybe you actually can take on a little bit more risk than 17%. In that case, you can get a better return than 14%. It depends on you. You're probably already using leverage. A lot of people say that leverage is risky, and well, it isn't. Your mortgages are a form of leverage, right? You're borrowing money to buy an asset which will appreciate in value, and even if it appreciates in value at the same rate as the interest rate on the mortgage, or even less than the interest rate on the mortgage, because you're doing this instead of paying rent, right? I mean, I'm not teaching anything here. You already know this. It's a lot better to do it that way, okay? A mortgage is a very good thing. A mortgage is a good type of leverage, okay, where money is borrowed to invest in order to have more money later. Another example might be a student loan in theory, because you are theoretically investing in yourself and you're going to earn more money later. Governments take out debt to invest in their countries, and then that earns them more money later. The farmer's tractor, if you're a farmer and you don't have a tractor, everything's going to take up so much time. The amount of crop that you can harvest in a year is not going to be very much. Okay, but if you take out a loan and buy a tractor, now you can do so much more, that you can do so much work that you can pay off the cost of the tractor, and then you keep the increased productivity from the tractor and obviously the increased money from that. It's a method of getting good debt effectively. But bad debt is where money is borrowed for things which don't earn money at a faster rate than the interest on the debt. So cars depreciate in value, for example. Luxury goods, don't do any of that, but get comfortable with good debt. Okay. With a mortgage, again, I'm not teaching anything here. You lose all the money you're renting with. A mortgage is a good thing to do. And this is the point of leverage. You should be using leverage to decrease risk while increasing return. Now, does leverage cost money? If you borrow money, how much do you pay for that? Well, it depends who you borrow from. On IB, which is Interactive Brokers, that's just, if you want to know where to borrow money, the answer is any good broker will do this for you. On IB, the cost of getting US dollars right now is 2.38%, which is set by the central bank. And then IB add an extra between 0.3 and 1.5%, depending on how much money you have. Generally, the lower rates are only for the multi-millionaires. Okay, 1.5% is a good rate for most retail investors. The thing is, if you wanted to borrow Canadian dollars, you can actually get that a lot cheaper. Okay, because the interest rate that the Canadian central bank has set is lower than the interest rate than the American central bank, the USA central bank. If you wanted to buy pounds, well, if you wanted to borrow pounds, that's a lot easier. Okay, a lot less money to do that because the interest rate is lower. There are some currencies that you can get for a 0% interest rate and you only have to pay the fees on them. Okay, that's currently, I think that's the Swiss franc, the Swedish krona, maybe, and the euro and the Japanese yen. It does seem to be that the euro and the Japanese yen are looking like they're going to be at 0% for quite a long time. Okay, the pound might go to zero in the next recession and stay there for a very long time, and the US dollar will probably go to zero at the next recession and stay there for not quite so long. It does change over time, of course, and you should be aware of that. But if you can get a long-term interest rate of just 1.5%, that's obviously very good. And if you integrate that into the calculations that we made earlier, this 14% return, where this borrowed money costs, say, 3%, that would decrease this 14% return to 12.41%. Okay, that's just the cost of borrowing that you're adding onto here. So you actually get a 12.41% rate of return with a 70% risk. So again, it's only a little bit less, but obviously it's well worth it to get a 12.41% return instead of an 8% return. And this 8% return where you borrowed 21% of that means this 8% would go down to 7.48%. So you'd need to use a little bit more leverage to target this 8%, and therefore you might take on a bit more than 10% risk. But like I said, still definitely worth it. However, currency risk comes into play. The value of currencies fluctuate. They change over time. This is a chart of the British pound against the US dollar. Let's say I, as a British person, took out a loan of US dollars. And this is what happens when you take out money in other currencies. When you borrow money in other currencies and then you change it into different currencies, right? You change it, say you borrow in euros and then you use that to buy US stocks. You're converting euros into US dollars to do that. Then you introduce currency risk. And let's say I borrowed a bunch of US dollars up here. Since then, the value of the pound has decreased by about 30%. So if I change dollars into pounds up here, I'm actually going to, it's kind of like I owe 30% more, right? It's kind of like I lost 30%. And that has the effect of increasing your risk, right? Because that's an amount that this has fluctuated, which is very significant, actually. What you can do is hedge this risk, okay? Which means you would borrow more money to take out a short position on this chart, on the pound against the dollar. So you would take out more money, short the pound against the dollar, and you would take out so much money that you would hedge whatever the risk is. So, you know, you would hope that if you took a short position here and it went down 30%, the amount that you would gain on that short position would what would you call it? Eliminate the loss on your other position where you've taken out the money for in the first place, and that's hedging the currency risk. To be honest, though, it's only really hedge funds that worry about this stuff. Okay, as a retail investor, you probably don't need to worry about that. It depends on your goals, and it depends on how long you're going to do this for. This is just a chart of that, but in reverse. Okay, I've just turned it upside down so you can see that, again, if you went long in 2008, you would have earned a lot of money. Currencies tend to just go up and down, and generally over time, over a period of 20 years, they generally just go sideways. Okay, it's not like the stock market where it tends to only go up. Okay, they go up and down a lot. So perhaps over a period of time, it might not really matter that much, but you should bear in mind this extra risk that you might be taking on. Futures contracts are a way of doing this if you don't want to actually borrow money. Okay, a futures contract is just a contract to buy an asset sometime in the future. And they are leveraged. That's the point of them. They are inherently leveraged because you're not actually buying the asset. You're buying a contract that represents the asset. And for that, you only needed a deposit because you're not buying the asset, right? So sometimes that's as little as 5% of the asset price, which gives you a massive amount of leverage, 20 times the amount of money that you put in. For example, if you bought a contract of the S&P 500, that has a $6,000 margin requirement, okay? 20 times that, 20 times 6,000, which is 120,000. That is the amount of that's the amount of the S&P 500 that represents. So that would be like buying a $120,000 position in the S&P 500. Okay, that's a lot. Okay, that's obviously a big amount, and you can't buy half a contract. They have introduced micro contracts quite recently, much smaller contracts with less of a margin requirement. But, you know, to only use moderate leverage, you need a lot of money, and to keep it there, you need even more. To use futures really effectively, you need a lot of money. So this is not so good for moderate leverage. It's much better for traders who take very small positions. Okay. Options are another way to use leverage, something called a call. An option is a contract to buy an asset at a certain price at a certain time. You don't really need to know the details of it. What it basically means is huge leverage. Okay, there's calls and there's puts. Calls is like long position, puts is like a short position, and it's essentially highly leveraged, but it is still costly. They do have wide bid-ask spreads, far more than futures, and the cost is reflected in the time decay. They do tend to decay over time. You can use options to hedge the futures risk. Okay, so then you don't need such a large amount of money to use moderate leverage on futures. So you would over leverage with futures and then take the opposite trade with options to hedge the downside risk. Okay, so you would buy an S&P 500 contract and then buy some S&P 500 puts, and that would effectively, it would reduce your exposure to that asset so that you're not over leveraged. If you actually do the maths on this, it's very complicated, and I think it's probably easier to just borrow money. Okay. The point that I want to make, though, is that a moderately leveraged and highly diversified portfolio can be less risky than a non-leveraged and non-diversified portfolio. Stop thinking of leverage as being risky, because it's what you do with it that counts. It's not inherently risky. However, there is something called tail risk. Okay. Tail risk is the possibility that your investments decrease by more than 3 standard deviations, which might mean a 60% drawdown. With leverage, that could wipe you out. But without leverage, you can just hold until it bounces back. Okay. The financial crisis was an example of this. I think the stock market, the S&P, I think it decreased by about 58%, something like that. If you were leveraged in that, you might have been completely wiped out and you would not be able to hold through that. Okay, but if you're not leveraged, you can just hold through everything and it will probably be all right. Tail risk is defined as a less than a 0.3% probability occurrence. But these things can still happen. And if you're only planning for having enough money to hold for a 40% drawdown, that isn't enough. Okay, you have to bear this in mind. Everything has a small chance of being worthless. A stock index can go to zero if the businesses get destroyed in a war. Bonds from those businesses become unable to be paid back, and even government bonds can theoretically become worthless. But, of course, cash can become worthless too. If you look at Venezuela right now, the hyperinflation that they have there means that, you know, any money that you have today is worthless tomorrow. And even gold can become worthless too. Leverage increases the chance of being totally wiped out. A 50% decrease with leverage can turn into 100%. Okay, and your broker might set some margin requirements, which is the amount of money that you need to have in order to hold that leveraged position open. And that might mean that actually, it's not a matter of being wiped out 100%. If you get wiped out by just 70%, if you have a 70% drawdown, they might close your position. And obviously that's bad. You don't want to do that. So you have to plan for these things too. Tail risk is an unlikely scenario, but with leverage, you basically make it more likely. To get around this, you've got to diversify along all asset classes. Okay, and the more asset classes, really, the better. And again, you can leverage these to suit your targeted returns. See my video on risk parity to understand that. The point is that using leverage to diversify is good because you can reduce risk. But going in highly leveraged on a portfolio of 100% equities is really bad, right? But it's really tempting. You've got to look at this over the long term. Theoretically, an investment of just £10,000 or dollars over 40 years would turn into $411,000 with a 10% rate of return, but it would turn into 1.65 million with just an extra 4% per year. So again, you've got to be patient and look at the long-term, tiny changes, not going in highly leveraged and ending up risking too much. That's the thing that I want to make as the final point here. Leverage seems like it's a shortcut to massive wealth. It seems like it's easy. It seems like it's the answer. It seems like you're going to get rich really quickly. Don't think of it like that. You are human, you are prone to mistakes, and leverage can destroy you if you get carried away with this. Successful investors share the same psychology. They aim for steady gains over a long period of time. They have the humility to be passive, to not think that they know better than everyone else, to not think that they know some amazing opportunities that just can't fail, you know, to accept that anything can happen and to accept that they can be wrong and that they're not a born natural. They have a long-term mindset and they have patience. What made you click on a video about leverage? Perhaps it was impatience or needing to be rich or risk-seeking behaviour. It's quite possible that it wasn't, and thank you for coming. Maybe you're just curious and you're wanting to taking your moderate investing to a new level. But these traits here, impatience, needing to be rich, risk-seeking behaviour, they can destroy you. The conclusion of this video is that moderate leverage can decrease risk and increase returns when tail risks, psychological risks, potentially currency risks, are mitigated through diversification and just being passive. Okay. Thanks for watching, and if you want to learn more about increasing returns and decreasing risk, please subscribe. Click like to help me out, and if you have any questions, I can answer them in the comments. See you in the next video.